Manpreet, I thought we could begin on the oil conversation here. What do you expect OPEC Plus to do when this meeting eventually takes place? We understand the negotiations are very much centred on output quotas right now. It's likely they'll reach an agreement, but what it looks like at this point is anyone's guess.
Well, I think the context here is quite important, right? Because understandably, a lot of discussion on quotas and whether to extend production cuts. But in our view, is coming against a demand backdrop that is looking, at least in the short term, a little bit on the weaker side, at least relative to expectations. I mean, if you dial back a few months, a lot of positivity was coming through from the potential Chinese demand, but there were some questions about just the extent of strength of Chinese imports against where the economy was. So I think we're seeing a little bit of a correction back on that front, and that's of course coming at a time where there's some uncertainty on OPEC negotiations. So we think from an oil price perspective, that's perhaps introducing a little bit of near-term pressure. But I think in the short term, once we get through this sort of short period of uncertainty, it's still a range-bound outcome for oil prices, because China, of course, one question mark, and we think there's room for upside surprise, at least from an economic front, less so from an oil demand front. But at least we've got U.S. resilience that's lasted longer than what markets were expecting about middle of the year. So we think together the resolution of this uncertainty of what exactly comes from the OPEC meeting should lead to oil prices that stay within the ranges we've experienced now for a large part of the year.
Okay, fascinating to watch. And Manpreet, also I wanted to ask you about equity sentiment and direction right now, particularly in the United States. How much more room do US equities have to run, and yields, how much more room do they have to move higher as we look towards the end of the year now?
Well, I think when it comes to US equities, look, we've always sort of asked ourselves just how far this rally can go, because the seasonality is arguably quite positive, especially the further we go towards year end. But there are always a couple of conditions we've wanted to see alongside, and I think cap or falling bond yields is one of those, and I think we got that to some extent with the rally we've seen. In the short term, though, it does look quite overbought, both the equity market rally as well as the bond market rally of the fall in bond yields. So I think from this point, the bias and the path of least resistance, perhaps going all the way through to year end, is most probably still pushing a little bit to the upside. But I think that's not going to be in a straight line. I think from today's levels, both on bond yields and equities, we might be facing a couple of weeks of consolidation because we're running up against what chartists in our team are talking about being fairly strong technical resistance for equities and support for yields. So that we think will not be necessarily very easy to break through. But I think as long as we get this resilience cap bond yields and we don't get any downside, or should I say upside surprises on inflation, we think that there's a chance that we'll get right through the year of December. At least sentiment might stay positive.